Welcome everybody to whoever could join us this evening. Like I said, it's a great presentation that we brought to you for tonight. We're actually going to present a live deal, and we'll share how we looked at different aspects of selecting a deal. And I have with me I'm honored to have with me today Ashley Wilson, who is one of the lead sponsors of the deal, and I'll give more introductions as we go along. But I hope you're here to ask a lot of questions. I hope you have downloaded our investment package that comes along with this presentation. If not, that's fine. I can always send it to you later. I have most of the slides here that we'll walk through.
So the information contained in this presentation is privileged and confidential information, and the use of the information in any manner is strictly prohibited. If you are not the intended recipient, please make sure that you notify us. The business plan here that we are going to present to you is for informational purposes. It is not a general solicitation or securities offering, so make sure that you take note of that. Everything that is expressed in here is made to the accuracy of the information that we are aware of today, and we will take all best efforts to continue to update the information as it becomes available to us. Any pro forma type information where we are using forward looking terminology, and you can see examples within the text here, is made just in terms of the statements that we are looking to execute the property, but is in no regard it should be taken as a guarantee. So in terms of the financial disclaimer, there are several financial projections and forecasts. These are estimations and are hypothetical scenarios. And we explicitly make no representation or warranty of any financial projections or forecasts delivered in connections with the offerings. And then last but not least, that every investment has its own inherent risk, and this is no different. So make sure that you consult with appropriate parties, financial consultants, your CPA, legal advisor, before making any sort of decision on whether or not to invest as well. I'm having a little bit difficult time reading it, in all honesty, to see my placeholder here because the text is a little bit small, but I'm sure Raj will be distributing the video and slides after the presentation, so you'll be able to go through this as well.
Okay, that's great. Thank you, Ashley, and thank you for doing such a wonderful job. Now, to just quickly move on for today's agenda, we're gonna take, this, what you're seeing today is a presentation that is part of a larger investment summary, and Ashley has presented this a few times. But we'll quickly walk through the highlights. And I want to focus today's presentation on, how we leverage data and sort of to find this deal. And we'll talk a lot about that. We talk about the opportunity, what it is. So it's a property in Galleria, Uptown Houston, Texas. It's 150 units, B+ property in an A- location, built in 1982. The purchase price, as you can see, is about $19.6 million. Strong market fundamentals. And like I said, we'll talk a lot more about that. It's 2 miles from the Galleria Mall. Rent increases are predicted to be, about 360 unit, and we have multiple exit strategies in that. So a little more about the investment, and like I said, more on this will be presented in the investment summary. I'm not going to go talk too much about that. And this is how the presentation is laid out. We talked about some of the participants, our team, and then why Houston. That is going to be a big part of our discussion tonight. And why Augusta Court? What did we find in terms of the data that we looked at that led us to this property, and why we're very excited about this property? We'll talk about business plans, and then I'll give you some context on how to get in touch with us if you're interested in participating further. In terms of our team, we have a very, very strong team. I would not take too much time to introduce everybody here. One thing that I forgot to mention was that this is being recorded. And we would love to open it for Q&A at about halfway mark, so maybe 30 minutes from now. So please ask as many questions as you can. Type your questions in the questions box. I will be monitoring them, and we'll have Ashley or me answer them live for you. So coming back to the team, like I said, combined team experience, about 70 years in real estate. We have $500 million real estate and transaction invested in 15 states, as you can see on the chart above. Quickly, introduction about me. If you don't know me, or if you have, either you don't know me or you've got bored of looking at this slide, I'm the founder and managing principal of SmartCapital, a full-time real estate investment professional now. Had been in technology most of my career, but then moved to real estate in about 2012. You can read this little bit of me. Undergrad in computer science, then I did my MBA from Northeastern in high tech. My real estate background includes, I started off buying a condo in Orlando, then bought few more over the multiple years. And I own 9 condos in the Orlando area. I self-own a 15-unit multifamily near Boston. I manage over 650 units in general partnership and apartment syndications, and some of them have partnered with Ashley before, and I'm so excited to partner with her again because of what I've seen in the past working with Ashley. She's just phenomenal. And again, I run a very successful education meetup in the Boston area. If you've not heard of it, AIMS, Apartment Investing and Multifamily Syndication. I am also a member of the Forbes Real Estate Council, where I write periodically on technology and other aspects of real estate on that. I'm also host of a Smart Passive Investor Mindset webinar series. That's enough about me. Let me move on to introduce our host, the famous Ashley Wilson. Ashley is the co-founder of Bar Down Investments LLC and How's It Look LLC. She has over 10 years of real estate experience, has been involved in 40 million in transactions with both single family and multifamily real estate. She co-founded Bar Down Investments with her husband, Kyle Wilson, who is also on the chief general partnership team and will be available to answer some questions if needed. Kyle does most of our underwriting. Additionally, Ashley and her dad, Tom, also have very successfully built a business in Pennsylvania, How's It Look, which handles several transactions on housing flipping annually. When Ashley is not working on her business, she enjoys spending time with her husband and 2 daughters. And she says it very modestly, she is an amazing horseback rider and enjoys riding horses when she is not working on her business here. That said, quickly, the current team and previous holdings of the people who are part of the team, you can read this. And like I said, this will be all in your slides. The list goes on and on and on of the experience that we have here. Amazing experience with different members of the general partnership team. And Ashley, slow me down if I'm going too fast, because I want to make sure that we get to the meat of it. And then
absolutely, no, we're good.
We talk about the question and answer session. Okay, I just lost my mouse here, so let me just see where does this. Okay, I think briefly talking about our the property management team, MLDC. I mean, they have 150, well, not 150, 1,590 units under management across 9 properties. Lori Lindsay was the founder, and Courtney, who is the vice president. I have the privilege of working with these 2 ladies on a previous deal where Ashley and I are partner on, and I can't say enough good things about them. They're just incredible, hardworking, ethical, most amazing property management team that I worked with, and we're fortunate to have the same team working with us on the Houston Augusta Wood property as well. Why is this thing not?
And while you're on this slide too, yeah, this will be the 3rd property that I work on with them.
MLDC?
Correct. Mm-hmm.
Ashley, do you want to talk some more about MLDC's experience with you while I make sure these slides are working for
Absolutely.
me?
So MLDC was recently founded, but don't let that fool you. Lori Lindley and her husband, Mark, have been in this space for a very long time. Specifically, Courtney, and Courtney is Lori's daughter, and Courtney is a 3rd-generation property manager. So they come from a long line of property management. They actually go up to Washington, D.C. and lobby for owners and investors on the landlord side. They also too are very connected within the industry. Lori's husband, Mark, and Courtney's father, Mark, is one of the largest student housing developers in the entire country. So one benefit to me saying that is the fact that we can leverage economies of scale that most other operators can't tap into, because we can leverage relationships that are already existing through the student housing development connection.
Excellent. Moving on. So what sets us apart, right? The community, that it's our goal that every property, and Ashley's, purpose in life is to, I've heard her mission statement is to every purchase that we have becomes like the beacon of the community. We are able to achieve this by partnering with local companies, charities, organizations. And I've seen MLDC and Ashley put together programs in our previous property that are just amazing, in retaining our tenants. We do so much on the social front, on the property or on the web, just engaging the community to the best. What else?
We also partner with local charities and organizations. For example, we do school drives. We also partner with the Humane Society. We partner with churches and different smaller organizations to create win-win situations that their community benefits along with our community. So our highest compliment that we receive is when the city starts to refer our property, and that is no different than what we've faced on the enclave, on the property together that Raj and I already have currently, is that the city is actually recommending us for people looking for housing.
Awesome. Moving on. So yeah, coming back to why Houston, and we'll talk a lot about that. I actually visited Houston a few years ago as part of my, I don't know if I can see my shirt, it says Houston on it. As part of my golf membership, we play annually, and we went to Houston, and I just fell in love with the city. And I have been actually personally looking at properties there and making trips down to Houston. But then when Ashley called me and said, hey, we're looking at a property in Houston, I said, I jumped on the opportunity. I was like, that's great, because we have done a lot of market research on Houston and why we think Houston is a great place to invest. Here's a small trivia for people who have not, well, people who have seen this slide should not answer this question, but what city is Houston about to surpass population as the third largest in the US? Type your answers in the chat box and we'll try and see it if you get it right. I don't see the answers coming in, but again.
So a couple of people said Chicago, which is correct. Phoenix, we have Phoenix, LA, Chicago, but Chicago is the winner.
Okay, yeah, absolutely. So Chicago is the winner. So there's so many things about Houston, and I think, like I said, I would not bore you with my voice. Ashley has done research, I have done research, but Ashley, take us through why we picked Houston and what are so exciting about this Houston and the submarket and the property that we are on now.
Absolutely. So Houston is an incredible city because it just offers so many different opportunities. In fact, these are just the #1 awards. If we went through all of the #2 awards, that would take up a slide, almost duplicating this slide in terms of the content. One of the things that are really important to us when we look for a city is migration. And as you can see here, Houston won an award in 2018 from the infamous U-Haul reports on top US destinations. So U-Haul puts out a report every year, and what they do is they track where people are moving to, because obviously they're renting U-Haul trucks. So it's a really good indicator as to the migration patterns within the US. And Houston won that award, taking home the #1 spot in 2018. It also, if you look at all of these other accolades in terms of living and speaking not only the diversity of the city, where young adults are moving and millennials are moving, it really speaks to the type of city and the environment in which people want to live and reside. It's also a good city for expats, so people coming into the US from other countries. It got voted #1 in 2019. And I'm not sure if you know this or not, but it was also voted best hospitals in America. We'll get to that a little bit further, but one thing to note is Houston has the #1 largest hospital in the entire world. So I'm going to get to that a little bit further in the presentation, but just note that it takes up an entire zip code, which is pretty incredible. So just the zip code itself is just the hospital community. That is really important. Then the other thing to look at is the affordability. So Houston's one of the top cities in the entire country for dining out. And that's because the cost of living and dining out and eating and day-to-day expenses are one of the most reasonable cities. So in terms of having the cost of living where cities, where your paychecks go the furthest, it also won that accolade as well. In terms of cities on great cities to work, this is another thing we look at as an indicator on a good investment city. Once again, you can see a bunch of #1 awards that Houston received. So if we look at the highest average starting salaries, I just got done telling you about the affordability. So it creates a greater differential between the salaries and the cost of living, which is another reason people are moving to this city. Highest annual median wage for STEM workers. So it's attracting the science, technology, medical field, engineering. That's the type of businesses. And Houston continues to attract all of these different businesses because Houston really wants a diverse economy. And we'll get to that a little bit later on. If you look at commercial real estate development, it was a top ranked place to work in commercial real estate development, job creation by foreign direct investment, and growth prospects. So you can really look at the pipeline that's going on in Houston and see that this is not just a one-off. There is definitely staying power in Houston, and it's actually, there's a lot of momentum in Houston as a great place to work. So we'll continue to see that as they continue to put a lot of resources into attracting different industries. And finally,
did I miss something? Yeah.
The invest slide.
Oh, okay, hold on. I mean, it's moved on somewhere here. Okay.
There we go. So not that I have this presentation memorized or anything, but in terms of investing, it was ranked the nation's top buy market for multifamily in August of 2019, which is pretty incredible. It also too was the top metro for most capital investment projects and best state to start a business, really speaking to the attractiveness of going into this city and investing and starting a business there. It is also the best state for landlords, as reported by Fortune Builders in 2020. So that's another reason we like Texas in general, because it's a landlord-friendly state, but Houston really lends itself well to that too, because it also is very complementary to landlords. It was voted one of the top US metros for area population growth. Population growth, as you all know, is a very strong indicator on good cities to invest in. Manufacturing on the US GDP, and top metro for economic growth, ranked #1 as well. So really strong indicators across the board here in terms of the overall strength of the city.
All right, I know why I jumped over the slide, because I was so excited about this poll question, and we'll put it out there again. And again, if you have seen this presentation before or heard about this, then you may want to hold on till we get some of the answers. What percentage does the oil and gas industry make up for the entire Houston economy? Ding, 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 ding.
So we got an early response of 25%, 10%, 5, 20.
All right, so the answer is
the oil and gas industry only makes up 2.7% of the economic industry of Houston. As you can see, it's one of the smaller percentages across the entire employment sector. So that is, I think that's shocking to a lot of people. In fact, when I originally gave this presentation, and just to quote the source here, it's from the Texas Workforce Commission, October 2019. When I originally gave this presentation, someone came to me afterwards and said, I spent 2 hours trying to debunk what you told me during the presentation, and we could not find anywhere that it debunked this 2.7%. Please do your own research. I'm not using that as a comment to not do your own research. I'm just telling you, it was very shocking to me when I learned that fact too. So I understand where that individual was coming from. If you look at the oil and gas industry and you look at the fringe industries, so when I say fringe, what I'm talking about is supportive industries. So that could be anything that's a supportive activity. So you can see here for mining, fabricated metal, manufacturing, agriculture, all of those different industries collectively, including oil and gas, they only comprise 7.4% of the entire economic industry. So one of the things that was really kind of eye-opening to me when I first looked into Houston as a market, and I'm sure, you know, Raj had the same reaction too, was that oil and gas was actually ranked number 8 in terms of industry rankings contributing to the economy in Houston. And what's also interesting is that technology is ranked number 9 and is going to quickly surpass the oil and gas industry, and oil and gas will take over as the number 9 spot because Houston has put a lot of energy and resources, I guess no pun intended there, but into the technology field and attracting different tech companies to come in. They are building a new center called the Ion, which is a tech center in downtown Houston that'll also bring a lot of tech jobs to the downtown Houston area, and that will obviously help propel technology above oil and gas. So gone are the days of Houston being solely reliant on oil and gas. I think this parallels very well to when people still think of Pittsburgh as a steel town. It hasn't been a steel town for over a decade, but it's really hard to lose a reputation. It's really important to look at the data and look at the facts to see whether or not the reputation is consistent with the actual data. In this case, it's not. And that's a reason we actually like the Houston market, because a lot of investors haven't caught on to this. So it makes it very advantageous on the acquisition side because we can come in and we don't have to compete with people who are overpaying for properties.
So true, so true. And I absolutely, it was a shocker for me. And that's once I found that out, I started following this market very closely. Now, actually, Houston is a pretty big city, and we are very fortunate to be finding this property in the upscale or uptown Galleria area. Why don't we talk a little bit about what that means to, you know, people and this property itself?
So narrowing into the Houston Uptown Galleria area, because what we first were talking about, we were talking about the accolades that Houston has as an overall market, but let's now focus in a little bit more hyper-focus into the Galleria area. The Galleria, as you can see from the picture, is known as the Galleria area, the Uptown area, because of the Galleria Mall. So you can see the Galleria Mall in the top part of the screen here, and the Galleria houses restaurants like Nobu and Capitol Grill, and they house stores like Saks Fifth Avenue. It's a very high-end retail center, so much so that it is owned by the Simon Mall Industries. And Simon, the last time they did a study on this particular mall was in 2013. And what they found out in 2013 was that the average foreign investor that would come to the Galleria area would stay on average 2 weeks while they were visiting, and they would spend on average $5,000 per person. So that is pretty extraordinary. And I can only assume, I mean, obviously COVID has had its challenges, but I can only assume that those numbers have increased since 2013. Unfortunately, that's the last data set that Simon Mall conducted. In addition to that, in the Uptown area and the Galleria area, it is no surprise that it would have a large tourist attraction to it. So it has 30 million annual visitors a year. Within this specific market, there are 200,000 residents. We have 12% is Houston's total Class A office space is just in the Galleria and Uptown area. So all of the supportive industries that come with Class A space, like restaurants and supportive stores to help execute all of those businesses are very prevalent in this area as well. There are over 2,000 companies in this area, and it is ranked the 14th largest office space in the entire country.
Wow. Now, people who may not be very familiar with the Houston in terms of geography, this map shows where exactly the property is located and compared to downtown Houston, right, Ashley?
Correct.
So as you can see, it's what would it be, west of Houston, or yeah?
Yes, so it's west of downtown, but I want to say for anyone who is yet to go to Houston, Houston is like any other city that you probably have ever been to before, because Houston has a very unique zoning ordinance, meaning that they don't have a zoning ordinance. So like other major MSAs across the country where there are high-rise sections in a downtown area, in fact, the entire downtown area is typically comprised of high-rise buildings. In Houston, because you can really change the zoning on a particular land overnight and build and put whatever you want on a land parcel, it makes Houston incredibly spread out. So there are pockets of high rises, and then right next to it could be a residential house with a half an acre. So it makes it very interesting, and this property is no different. So this property is located just 2 minutes from George W. Bush Sr.'s house, who has land, and even across the street from the property. So the property is at the almost at the intersection of San Felipe and Augusta Drive. There's a parking garage and then one building before San Felipe. But if you cross over San Felipe, there is a residential pocket there full of half-acre parcels. So, and then a mile down the street is the Galleria Mall, and there's a lot of commercial buildings there. So you can see that the topography changes very quickly in Houston, and that all relates back to the zoning.
And like they say, real estate is all local, but I think I would take it one step further and say real estate is actually hyper-local. That's not my words, but that's I've heard. And it is so true that real estate or your asset is so hyper-local. So let's talk about the actual neighborhood of Augusta Court, Ashley.
So now we're even narrowing the lens even more so. This is a report, all of the data that is taken here is from a report called Neighborhood Scout. Neighborhood Scout looks at a specific pocket, and in this case, it is 0.8 miles on the y-axis, and I believe it's 0.5 miles on the x-axis, both north and south of the property. So it builds basically a rectangle around the property and looks at the data within this specific niche of the uptown area. So pre-COVID unemployment in this particular pocket was 3.3%. That is below the US average pre-COVID at 3.6%. What's very unique about this market, this specific neighborhood, is that 77% of the people that live in this area have a college degree, and 36.9% have an advanced degree, and you can see the respective US statistics across both the college and advanced degrees. In terms of the types of professions, the type of professions that the people who are living at this property along with the neighboring properties, 69.1% are executives, managers, and professionals. This is really important to note because I'm sure a lot of you have questions surrounding the occupancy, both physical and economic, on the property, and we'll get to that a little bit further, but you will be able to see, due to the type of professions that the people have on this particular property, there wasn't as much of a hiccup as there was, say, on another property. In fact, there wasn't too bad of a hiccup, period, because this area is such a strong performing area and a very highly professional area with high paying jobs, stable jobs. So you can see that the property wasn't impacted like other properties were. So I think, can we go to the next slide? Thank you. In terms of the medium home
Sorry, my bad.
No problem. The medium home value is $282,000. And if you look at the per capita income, it's $66,885, which is just incredible, especially when you consider the US average is 31 and change. So the reason this is so important is obviously because I spoke earlier on the affordability of Houston, which lends itself very well to being able to having the ability to save more, as well as being able to have a rainy day fund should, for example, COVID happen and you still need to pay your rent. So if you look at this particular market, this is a very heavy renters market. It's 61.3%. And what is very interesting about this area is that if you look at the historic average over the past 5 years, the blended average rental increase, so natural inflation is what I'm talking about here, is 3.4%. That's an important statistic to remember. I'm going to circle back to that later on, so just put a pin in that comment. Also, too, another thing I want you to remember, something I will be talking about a little bit later, is the market rent. So the average market rent in this area is $17.82. So this is something else just to keep in mind. That's as of today, or as of July 11th, when we created the presentation. So this is during COVID. The average market rent is $17.82. Just as kind of a preview of what's to come, the current market rent on this particular property is $13.11 today. So that is something that obviously shows you right away that there is a huge differential between the average market rent today on this particular neighborhood and what the property is performing at.
So like I said, there is so much goes on to, doing the research and the market analysis, and so much data that we have looked at, and that's all presented here. And that's how we chose this property, and we are, happy to have this under contract now. So let me move on and say, okay, what's notable and unique about these things? Well, what's the slide again? So, okay, wait, okay.
Oh, sorry, that's my fault, Raj. I did it to keep everyone's attention. So, you do one at a time, sorry. We mentioned earlier about the type of people that are living in this area. And in this particular area, once again, this data is taken from Neighborhood Scout, 63.1% of people are living alone. And I'm going to speak to that a little bit further when I talk about the diversity of the unit makeup. So a majority of people are living alone here. That's higher than 99.5% of all US neighborhoods. Bachelor degree, we already talked about this, so I won't waste time on that, and the professionals. And just in terms of this particular pocket, 71.5% of this area is comprised of apartment buildings. So that's just something to note as well, that this is, definitely an area for renters.
Now let's talk about the property itself, right? And maybe talk some more about the business plan that we have on this.
So in terms of the property details, just to refresh everyone's memory, we're purchasing it at 19.6, which is about 130 and change per door. The previous agreement, we actually had this under agreement prior to COVID, was 22 million. So that's an 11% discount. We feel very happy about that discount, in all honesty. The property was built in 1982. It's 150 units. It was previously a condominium, but so the units are actually individually deeded. And if you remember, one thing I said earlier was about the zoning, and what Raj said earlier about our 3 different exit strategies. By having the properties already individually deeded provides a third exit strategy, which a lot of other properties do not have, and that is the ability to sell them off as individual units. Now, I'm going to just caveat that by saying that is not the most advantageous play out of the 3 exit strategies, but what it does is it just gives us another option should the other 2 strategies have challenges on their own right. So most properties have typically 1 exit strategy. This property has 3. So I mentioned the separately deeded, The other thing is obviously the value add, but one thing we didn't talk about is this area, because it's such a strong A-class area, this is the last remaining B-class property, large B-class property in this market. So it lends itself very well to be attracted to builders and developers. In fact, there were several developers that looked at this property while we were looking at this property too. So that kind of shows you that, if today they're already interested, most likely we're going to have some interest as well when we go to exit the property too. And then I already talked about, it's the last B-class large multifamily property in this A-class location. The hold period is 5 years, and I just noted the exit strategies, so we'll move on. The current occupancy status, this has changed in all honesty. So when we originally did the presentation, we were at 92% occupancy. One of the things we put in the purchase and sale agreement was that they could not dip below 92% occupancy, and we put conditions on which that they could rent up the units, meaning that they couldn't offer a concession or a rent price lower than what they were offering in January. So that means that the rents that they were offering in January to a prospective tenant are the lowest in which they could offer today. They also too could not qualify someone under different qualifications than what their historic qualifications have been in terms of the rent to income ratio, the criminal background check, all of the typical checks that you make sure that a tenant qualifies on the property still had to be upheld. So I'm happy to report that the current occupancy today on the property is 95%. The annual average occupancy on the property per yardie is 97.9%. The dip in the occupancy, just to address this question, because I know I've gotten this question multiple times, is due to most people think it's due to COVID, but another reason too is this particular owner, when the owner listed the property on, listed the property for sale, they, one of the things they did is they cut their marketing budget entirely, and they also reduced staff too, to operate on the thinnest expenses that they could, operate on. So that was a reason in which there was a dip in the occupancy. I actually believe that that was more of a reason for the dip in the occupancy, more so than COVID. I'm not trying to discount COVID. COVID probably does have a role in it too, but I think by and large, when you are not spending any money on marketing, it's very difficult to attract tenants. In terms of the average rents, it was at $1,306. We're at $1,311 today, and as we mentioned before, the average market rents are at $1,782. In terms of the tenant income, this is an anomaly in all honesty. So typically on a property that is a value add property, if there is a $100 rent bump, you might be able to capture the current tenant base and keep that tenant base on. But one of the things that you do when you qualify a tenant for their rent to income ratio is the industry standard is 3x. So let's say, for example, that the rent was $1,000, their income must be $3,000 or greater. What's very unique about this property, and it makes it an anomaly, is that we have projected a $360 average rent bump, and that current tenant, that gets us to $1,789 in year 5. The current tenant base today could afford for the rents to be at $1,809. That's incredible. That's absolutely incredible, because it's such a large rent bump, and yet our current tenant base alone could afford what we're projecting. They can actually afford more than what we're projecting, and that's 5 years out. So that is something that we found very, very, very interesting on this property. And then the other thing that's very interesting on this property is 93 units out of the 150 have called Augusta Court their home for over 2 years, and a majority of them are actually 5 years or more. So people love living at this property. The location is truly dynamite, and they like it. It's their home. They want to stay at the property.
And that speaks huge, huge volumes to the quality of the property and the neighborhood. That's absolutely true. Okay, I think we want to talk about unit mix a little bit.
Yeah, so the unit mix, we have a majority of 1 bedrooms, 1 bath, and then this got cut off here. I have an updated slide I can send here, Raj. But the 1 bedroom in the den actually has 2 baths, and our units are extremely large. So one thing to note is this is an A-class area, and as I mentioned before, this is the last B-class property in an A-class area. So what do I mean by that? I mean that all the competitor properties are A-class product. When you build new properties, the cost of building is so much higher than it was in the 80s, meaning that the unit size was the compromise. So an A-class product, all of the unit sizes are much smaller than a 1980s vintage. That's pretty commonplace across the entire country, let alone for this particular property. So the 1 bedroom in a den, which makes up the, by and large, we have 122 of those unit types. They actually could be a 2 bedroom, and they already have 2 full baths. So there is an option, and we are going to test it out, whether it's better to convert the 2 bedroom to the 2 bath. But one thing I noted before is that 63.1% of people live alone in this market. So typically we look for a more balanced unit mix at a property because, there's normally a 50-50 ratio between people wanting a 2 bedroom versus a 1 bedroom. What's interesting here is that most people do live alone. So this property complements itself very well to the demographics of the people in this particular market. If that were to change, we do have that option, and these units are large enough, we can easily convert the den to a 2nd-bedroom. In fact, the 2-bedroom, 2.5-bath is very comparable footprint to the 1 bedroom and the den. The other thing that's very interesting is the 1 bedroom and den with 2 full baths. All competitor products are only 1 bedroom and a den with 1 bath or 1.5 baths, but none of the competitor none of the A-class properties, because they're not truly competitors, none of the A-class product has 2 full baths. And on the 2-bedroom side, very few have 2.5 baths. In fact, the comps that we used in our analysis didn't have an option for a half bath. It was 2 full bedrooms and 2 full baths.
Let's talk about some average rents here.
Yeah, I think, do you have the next slide on the rents? It might depict it a little bit better.
This
Yeah,
one?
yes, okay. Yeah. So when we look at the 1-bedroom comps now, the Augusta Court price is $11.50. And today, the Phoenician Apartments and Tate at Tanglewood are $13.42 and $14.48, and the market average is $15.97. One thing to note with the market average, it is something of interest, and we want to stay below the market average. But as I noted before, the market is heavily dominated by A-class product. So really, we're looking at these 2 apartments. Tate at Tanglewood Luxury Apartments is a newer vintage property. However, it is almost directly across the street from Augusta Court. So it's worth noting the rents that they're getting. And Phoenician Apartments is a 90s vintage property that has never been renovated since it was constructed. So when we do our renovations, it will, in all honesty, it will surpass the finishes at the Phoenician, but still, since it's a newer product, it's something to just keep in mind. Augusta Court post CapEx is $13.60. A common question that I get on the next 2 slides, inclusive of this slide, so I want to preemptively answer it, is that I have Augusta Court surpassing the Phoenician Apartments when I just said the Phoenician Apartments are a newer vintage, and that is the same on the following slides. Keep in mind, my $13.60 is post CapEx in year 5, whereas the Phoenician Apartments and Tate at Tanglewood is today. I also told you that the historic average inflation at those in this particular market is 3.4%. Even if you were to drop that down on average to 2.5 or 3% blended over the next 5 years, you would still have a several $100 differential, $200 to $300 plus differential between what the properties are currently renting at today and what they will be renting at 5 years from now. So I don't have in here what Phoenician apartments at Tate and Tanglewood will be priced at in 5 years, but if you take historic natural inflation, there will still be a significant differential between our property and those properties. And that's what we want to do. We want a couple $100 buffer between our product and their product.
Absolutely, absolutely. I'm glad you mentioned that, because people might be wondering, hey, why are you more than Phoenician? But clearly this is 5 year projected out and Phoenician is today. So,
Correct.
And again, these will all be in your deck that I send over with the recording. So let's talk something about the business plan a little bit, Ashley, because I'm sure people are curious to know what is our plan here.
So in year one, to be conservative, we have underwritten 0 rent bumps, and we actually increased the vacancy to 16%. So vacancy, concessions, bad debt, and loss to lease. Today, so that is speaking, by the way, on economic, not physical. So today, economic is at 90%. So what we're saying is that the property will be on year one average at 84% with 0 rent bumps, meaning we will not deploy our value add strategy until September 2021. In year two, that's what I'm just talking about. That's when we'll deploy our value add strategy, and we will see a $97 rent bump increase, and we increase the economic occupancy by only 2%. So we underwrote that it'll be at 86% economic occupancy. And as a reminder, today it's at 90. In year three, we see $165 rent bumps. We go down to 10% vacancy, concessions, bad debt, and loss to lease. Year four, we're at $165 rent bumps, 8% vacancy, concessions, bad debt, and loss to lease. Year five, we are stabilized, and we are at a 52 rent bump, which is consistent with natural inflation. And then we are once again at an 8% vacancy, bad debt, concessions, and loss to lease.
Thank you. That was pretty fast talking, and I'm
trying to go quickly because I know we got to get to the questions.
Right. So I think you've already talked about some of this of what we're doing with the capex, maybe not, but let's quickly talk about that.
So we have a 3-prong approach. We're going to tackle the interiors, renovate the floors, cabinet faces, the countertops, etc., all the fixtures, new painting. With amenities, we are going to paint the exterior of the building, upgrade the pool. We're going to convert the gym to a leasing office and business center. And we're going to upgrade the sun deck and add a grilling station. One other thing that we didn't talk about is the existing leasing office is actually already a unit that they're using as a leasing office. So we are going to convert that back to a unit. We did not underwrite the added value that having that unit will bring, but we did underwrite the cost of converting it. So that's another conservative measure we took. And then in terms of the management, we also believe our management team is stronger than the existing management. I know a lot of people say that, but I truly, Raj can also vouch for this. We have an incredible program on deploying and attracting a new tenant base, as well as just updating the property and squeezing as much juice out of the lemon as possible, as we like to say.
Absolutely. And, one of the questions that come up frequently is, so what are the sources and uses of funds? And this table, clearly describes what are the sources and uses of funds for this raise of property.
Yep. So here we have a Freddie loan at 14 and change, and then the investor sponsor equity, we're at 8.3. The purchase cost, as we mentioned before, is 19.6. Closing, we're a little under 600. CapEx and reserves, we're at 1.85. Our acquisition fee is 392, which that's how you get the sources and uses to match up at that 22 million and change.
And again, I want to repeat that. If you are interested in participating alongside us in this deal, absolutely reach out to me and we can answer more questions, maybe have phone call chat. And this presentation is just an overview of what is in the investment package. And a lot comes along. We have previously recorded webinars, Q&A sessions that we can share if you're interested. But let's keep going here and talk about operating forecast. Hold on.
So in the operating forecast, you can see at the beginning, the annual rent escalator, as I mentioned before. So the blended average natural inflation in this market is 3.4%. We've underwritten in year one, no natural inflation. In years 2 and years 3, 2%. In years 4 and 5, 3%. We don't even match historic average of 3.4%. That was another conservative measure we took. In terms of the average monthly rent today, I told you that it was $13.11, and then we already talked about the rent bumps moving forward, and consistent with the economic vacancy, you can see the 16%. If you add the 8% and 8% to the right of the vacancy and concessions and loss to lease. In terms of where that gets us to on the NOI side, on the NOI, we are at 981, 075 for year one, which gets us to a cash flow available for distribution at 527, 765 after principal and interest. We have a 3-year interest-only loan, so that's why the principal is zeroed out from years 1 through 3, and that's why in years 4 you see that principal kick in. In terms of the cash flow available for distribution, this is inclusive of the asset management fee and the cash flow for all of the investors. So that's what comprises that number.
I know there's a lot of data that you saw on that screen, but we just want to give you a flavor of what the business plan is and what we have, baked into this, which I consider extremely conservative,
In terms, yeah, absolutely. And we'll get to that. We have a slide on all the conservative measures we took a little bit later on. But in terms of investment structure, we have a waterfall structure. So the investors have an 8 pref. So the first 8% goes 100% to the limited partners. After the 8%, we come to our first hurdle. So that is the 8 to 12%. There's a 70-30 split. After the 12% is achieved, 12 to 14% is a 60-40 split, and 14% and higher is 50-50 split. One question that I've gotten asked often is if there's a shortfall, which we'll see in the next slide, happens in year 1, is there a rollover and a catch up? Yes, there is. So the 8 pref is always achieved. So any year that we fall short of it, which we have projected to happen in year 1 only, there will be a catch up in the subsequent year. So you can see here exactly what I'm talking about. In year 1, the cash on cash return is only at 5.84%. And in year 2, there's a little bit of a shortfall on the 7.35, but you can see how that rolls in and gets to year 3 at 11.27. One question we've been asked is how come year 3 is at 11.27 and then year 4 drops to 10.77? This is because of the interest-only loan expiring. So in year 4, the principal kicks in. So there's less cash flow available for distribution in year 4. So that's why we see that minor bump down to the 10.77. In terms of the overall returns, you have an average cash on cash return, of 9.34% projected, a projected IRR of 16, a projected average annual return of 18.26, and on the multiplier, it is 1.91, which means that you're projected to almost double your investment. So 1.9x within the 5 years, because it's a 5-year investment. This is an example. Oh,
$200,000 example, right? If you
yes.
invest $100,000, yes, please go ahead, Ashley.
So this is a $200,000 example. I'm not going to go through the percentage of returns because they stay the same. But what I will do is speak to the actual dollar amount that you will get back. So what we're looking at here is you're looking at the cash flow along the way. So the cash flow along the way totals $99,394. That's what we are projecting. underwriting through the 5-year hold. In terms of the proceeds at sale, we're projecting $89,166, and then obviously a return of your initial investment at $200,000. So you you have the $200,000 return of your initial investment, and if you add up the member cash flow along the way, coupled with the proceeds at sale, you get the $182,560 that you see there. In terms of the loan, I've alluded to this a little bit. We're going after a Freddie loan. The loan's at 14.12. It's a 72.04 loan to value. We might be able to creep up a little bit higher than that, but that's where we're at today. The interest rate's at 3.07. It's a 10-year loan with a 3-year IO on a 30-year AM.
And this next slide is actually my favorite slide, and a lot of people have asked for it. So make sure that, I always make sure that this is included. But Ashley, why don't you walk us through what this is? It's the sensitivity analysis slide.
This is a sensitivity analysis slide. And what we like to show here is we like to show what your IRR will be on a sliding scale. So on the x-axis here, you are looking at the net operating income and the differential based off of what we projected. So 0 is we've hit our target. 2% means we've overshot it. We've outperformed it by 2%. Negative 2% is obviously the opposite. On the y-axis, what you're looking at is the cap rate. So what we've projected is a 6 exit cap rate. In this particular market, properties trade between a 4.5 and a 5 cap rate. In all honesty, B class in our particular niche market trades between a 4.5 and a 4.75. But for argument's sake, in Houston, and just to be conservative, I'll use 5 as my starting point. It is general accepted practice within multifamily to underwrite 100 basis points per year held of a property. This is a 5-year hold. So when people underwrite, they typically would add 500 basis points to project the exit. So if you came in at a 5 cap, you would exit at a 5.5 cap. Because we are getting such a good discount on the property, we are entering at, originally we believed we were entering at a 6. Some things have changed and we're now down a little bit further on the scale. But in typical underwriting practice, you would use the 5 as, whatever the market cap is trading at. So this particular property is trading typically at a 4.75, most conservative. Houston at a 5. If you use 5 and add 500 basis points, that would be an exit of 5.5. So if we had done traditional underwriting, generally accepted underwriting at a 5.5 and hit our NOI, you can see that the IRR actually jumps up to a projected 17.94%. We are telling you this not to say, okay, we're telling you 16, but really we mean 18. So that's why you should invest. We're not telling you that. We're telling what we like to do. And, Raj is no different. Raj loves doing this too, is education. And whether it's our deal you invest in or someone else's deal that you invest in, the important thing is how to analyze a deal and what these things mean. You should always ask for a sensitivity analysis table and understand the market cap rates so you can make the most informed decision when deciding whether or not to invest. This is what we're showing you here. We are doing the exact same thing. We want to show you this is what a market trades at, but we're underwriting conservatively. And we not only say that we're conservative, all of our actions support it. So the numbers we're going to show you on projected IRR are based off of conservative measures we've taken. This is another example of us being conservative. And there's a slide that we'll get to in a moment, which has multiple measures that we are doing to be conservative to safeguard your investment and our investment.
Yeah, actually, I left that slide out because in essence of time, but it is included in the investment package. But I want to bring on to last slide. I know you're going on for a long time, but the most asked question. So what about COVID? We are in tough times right now, and Ashley, what have you done to make sure that we have safeguarded ourselves from what is going on around us?
So we have on the underwriting, we have 11% purchase price discount, which we've talked about already, which is huge. We've also to year one, no rent increases. Year one, we increased our bad debt to 16%, loss to lease, etc. I told you today that the property is actually only at 10 today. So we've underwritten 16 as an average for year one. In year two, we delayed the value add to start in year two, not at year one, which most value adds start at year one. If there's an opportunity to start earlier, of course we will start earlier. But what we've done is taken the most conservative approach on our underwriting to have those safeguards in place. As I mentioned before, we have a 6% exit cap. And also to our insurance, we underwrote is inflated. In fact, the insurance that came in on the property, and a question we often get asked is, is the property in a flood zone? No, it's not in a flood zone, but we are still getting flood insurance on the property. Regular insurance plus flood insurance came in at less than, we underwrote it for, $100 more per door than what the insurance plus and flood insurance came in. We didn't change our underwriting. We still have the inflated insurance rate in our underwriting. So that 16% is reflective of that, even though our terms are different, because we want to keep those safeguards in place. Another safeguard, and a question we got asked often, is what is the economic occupancy needed on the property to cover all of our expenses and debt? 69%. That is what we need. So that is very, very strong indicator, in all honesty. And then in terms of knowledge, just to give a little bit of backgrounds, I previously worked in clinical research and development for GlaxoSmithKline. And during the last pandemic, I was working within the vaccine development. GlaxoSmithKline was one of 2 companies in the entire country manufacturing a vaccine for H1N1. I am very cognizant of all of the processes involved working. I specifically worked with the FDA and the World Health Organization during those times and during my tenure in vaccine research. So my knowledge of what is going on in the world today was directly used to underwrite this property. In all honesty, I never thought that there would be a parallel between the two. It's pretty ironic. It's almost like a Slumdog Millionaire type moment. But at the same time, it is something that we have been able to leverage. And that is something that we've used on all of our projections.
Awesome. And I know, like I said, our goal today was to bring this presentation to you. I think it's the concise of the bigger business plan and bigger investment thesis that we have. And I'm happy to share that with you if you're interested in participating along or just have more questions. My information is on there. And now let me just jump onto the set of questions that have already come in. And Ashley, maybe we can quickly answer, because we promised our listeners that we will be answering questions. Okay, and some of this, by the way, I'm just looking at the Q&A box, so some of them may be answered already. Balaji asked, why is the occupancy low now, COVID or even earlier?
So that question was asked before I spoke on the previous owner, or the current owner, dropping the marketing and also their staffing on payroll. So just to reiterate, the occupancy dropped in what we believe to our research is more coupled with the lack of spending on the marketing side. We haven't seen any indication on COVID impacting this particular property. In fact, the property occupancy is increasing. So that's an even further indicator that when we put that provision in place in the purchase and sale agreement and they plug some money into marketing, the property just bounced right back to 95% occupancy, and they increased their economic occupancy from 87% to 90%. So we feel very strongly on our research being more reflective that it has to do with where the ownership was spending their money, not COVID.
Thank you. How far is Augusta from the Texas Medical Center? Do you know, Ashley?
19 minutes.
Wow. Not 20, not 18, 19. Sorry, I'm looking down at, because I have the Q&A box on the other screen. Do you have current unemployment data in that area?
I can get you that information. In all honesty, it changes kind of
Exactly.
frequently, but I can get that information and send it to you because I don't want to give you information that's outdated.
Balaji is asking again, what was the reason the previous owner not to raise rent? Would that reason prevent you from raising rent as projected?
The previous ownership group was a ownership group outside of the area. In fact, they are not even located in the US, and they are selling off all of their portfolios, all of their properties in a portfolio type sale. We looked at all of their properties, and all of their properties were underperforming. So when we look at how those properties were performing in terms of the management wasn't operating to what we believe the full potential of the property was. So that's all in when you buy a value add. What you're looking for is you're looking for either a distressed property or distressed ownership group, and you're really looking to come in and operate the property better. I always like to say multifamily, when you invest in multifamily, you're buying real estate, but you're also buying a business. So in this particular situation, the previous business owner was not running his business well. And we have the capability to run this business so much stronger than they are running it today. And that's why we believe that we will be able to raise rents through renovations and also better management.
Great, thank you. Sandy wants to know, will your proposed tenant mix miss the gym you are converting into a leasing office?
Excellent.
How do you decide this?
Excellent question, Sandy. So this is something that we looked into. So the gym, in terms of the configuration of the gym does not lend itself well for even 5 people to be in it at the same time because of the way that the layout of the gym is. It's a little bit of an awkward space. So we toyed with renovating the gym also because all of the equipment was residential or residential equipment as opposed to commercial equipment. The cost of renovating the gym would have been the same cost of converting it to a leasing office. And still, once we renovated it, it would still have the spatial configuration problem and only limit itself to about 5 people in the gym at the time. Because this is an A-class area, there are a lot of gyms in the area. And we also asked the frequency in which people are using the gym, and it is very low. So we believe that type of tenant base will want more of an A-class gym that we can't provide on the property. So we believed it was a better ROI to convert that to a leasing office, which we were going to do, and then convert our current leasing office into a unit so we can capture that additional income.
You notice I stopped sharing because I think we have enough of my contact information and present it again later. Moving on, Shelly is asking, Shelly from Boston, I know her, considering the financial strength of your current tenant base, is there a concern your tenant base will move to the suburbs due to the COVID and the ability to work remotely or buy versus rent with low interest rates?
No, I do not believe that we will have tenant base mass exiting the area. As I mentioned before, due to the zoning in Houston, it's not a traditional downtown and suburban or suburb area. So the suburbs don't, encapsulate the downtown area like a traditional MSA does. In Houston, when you drive through Houston, it is literally suburbs a little bit here, and then commercial next door, and then suburbs and commercial, and it kind of is all over the map. And in all honesty, if you want to live close to this area, in this area, the affordability of the houses, when I said that those residential houses across the street, those houses are $1 million plus. So in order to live in this area, especially if you're already working in this area, commuting in this area, yes, people are working from home, but there are people who are not working from home. There is, for example, the medical industry, which employs 106,000 people in Houston, and they have 160,000 visitors per day. If we have a tenant base that is going to that hospital, the affordability of purchasing their own home in that same area is not the same, which is probably speaks to why people have lived at the property as long as they have, because of the affordability.
Thank you. Let me just keep walking through. So is there any plans to do on a refinance during the value add or after doing the value add?
No, that is not what we are planning to do, because once we are done the value add, we will be looking to exit the property. If we obviously, if it's more advantageous to refi the property, that is something that we will consider, because ultimately all of our decisions are governed by what is best for the investors.
Cool. Thank you. Amit wants to know, as currently there is a 95% occupancy rate and no rent increases for the first year, we can assume the occupancy will be steady for the next year. And in this scenario, you will have only 5% units to do your interior upgrades. How do you expect to bump the rents by $97 and not expect renters to move out?
So there is a lot of different solutions that we can do for renovating units. So as a lease comes up for renewal, we can either renovate the unit for them while they're still living in the unit and do a partial renovation or a full renovation. We could also renovate an adjacent unit and move them into adjacent unit, or we can also house them in a hotel for a week while we renovate their unit. And then if we want to capture the same tenant that's in the property. In terms of the alternative approach, there's also an alternative approach where you force vacancy, meaning you raise the rent high enough that the person does not want to be there, and that forces them out, so you get the unit back to renovate. All of these are different strategies. There's even more strategies, but ultimately there are ways in which you can get creative to renovate the unit and either capture the current tenant. So most of the time on value add, just to be very clear, on a value add property, what you are doing is you're attracting a new tenant base. That's the whole idea of a value add. You're going after a tenant base that was not in the property when you acquired the property, but it's a new tenant that can afford the higher dollar. The only reason why this, discussion comes up, this is an excellent question, and one question I've been asked very frequently is the fact that the current tenant base can afford to stay in the property. That's normally not the case. So normally when we take a unit back or we force the rental price up, someone will move out. It just happens in this scenario that they might be able to stay in. So prior to COVID, when we had underwritten the property, because we've underwritten the property obviously 100 times since COVID with all these different scenarios. But prior to COVID, just to kind of give you where we were at, we knew we could raise the rents $150 without doing a single renovation on the property. So we know that we can push the rents quite significantly and still maintain a high occupancy on the property, even if it meant that that person was going to vacate the property, because there's such a high demand for this property. Now, in that particular situation, the property was almost 100% occupied and they weren't doing any marketing. So they stopped marketing and then the occupancies started to tailor off. But that goes to show you that when you do market this property, there's a huge demand because the affordability of this property. And even if you raise the rents $150, there's still such a huge differential between this property and all competitor properties, because what I showed you on those rent screens were the rent comparables. That is not including all the additional fees that come with an A-class property. Like, for example, on an A-class property, they charge amenity fees or trash valet. There are all these different fees that get added to the rent. So your base rent might look, $300 different than Augusta Courts rents look. But then when you add on these additional fees, there's really a $500+ differential between the two.
Great. Rohit wants to know, what is the 11% discount you mentioned and what is the current cap rate?
Great question. So the 11% discount is, we had the property under agreement at 22 million prior to COVID. And today we have it, under agreement at 19.6. That's how we, have the 11% discount. We renegotiated the property. In terms of what is the current cap rate, I believe it is 5.6, 5.6. I'm checking with my underwriter over here just to confirm nothing has changed since the last time he told me an update.
So I'm just browsing through the question, making sure we are not bringing up questions that have already been answered during the presentation. And if I leave some questions out, I'm always available by email, and please get back to me. But I also want to respect everybody's time. Let's go. Matthew says, how does the decision to buy flood insurance affect the lender's underwriting and interest rate?
The flood insurance was not required on the property. So in this particular situation, in terms of the decision to buy flood insurance affect the lender's underwriting and interest rate, it has no impact on it because it wasn't a requirement. This is a safeguard that we put in place to just add another layer of protection for all of us on this investment, to have flood insurance just in case, God forbid we need it, but this was not a requirement by the lender, so it doesn't affect their underwriting. Okay.
Rohit also notes, did the assets get affected in the last Houston flood?
Okay, let me answer that question a little bit better than just shaking my head no. In terms of did the property get flooded because of the Houston flood, because of the actual rain on the property? No. What we believe happened was because of the volume of rain that came down, the sewer system in Houston was at max capacity. In fact, it was over its capacity. So what happened was all of the sewer systems backed up. So this particular property has the garage underground. So what happens when you come off of Augusta Drive, you turn into the property and you can either go up a story to the first level of the property, or you can go down a half a story to the garage. And in the garage, there are obviously drains, and those drains connect to the public sewer and septic systems and the stormwater management systems, and the water backed up into these drainage and flooded the garage. No units were flooded. If you look at the overall topography of Houston in this market, not a single property was flooded. It was just the water coming up within the garage, but nothing else on the property had any water intrusion.
Makes sense. Thank you. Devin wants to know, what is the purchasing cap rate? Maybe we answered that. Do you have the entrance cap rate same as the exit cap rate?
No. So you always do a difference between the entrance cap rate and the exit cap rate. So the entrance cap rate is a 5.6 and the exit cap rate we did as a 6.
We talked about the floods. Matthew wants to know, what percentage of the 150 units will be updated over 5 years?
100%.
Oh. Will the tenants be okay with the rent increases every year?
I mean, I don't really think so. But in terms of the average rent comes from renovating the unit. So what we're doing is providing a better product. We aren't just raising rents for the sake of raising rents. We are taking a product that they currently have that is outdated and worn down, and what we are doing is providing new flooring and new kitchen cabinets and new countertops and new light fixtures and plumbing fixtures and finishes and paint. So what we're doing is giving them a better quality product. It's up to them if that is something that they want to stay and pay for, or if they want to look for another product. But ultimately what we're trying to do is create a better product.
Balaji wants to know, is there any opportunity for other/miscellaneous income like laundry income on the property?
Because these properties, because these units, excuse me, were individually deeded and they were condos originally, they all have their own washer and dryer in the individual unit. So with respect to the laundry income, there isn't a traditional laundry income collection from the actual usage of the machines. There is an opportunity though for renting of the machines. So we can provide the machines and they can rent the machines, or they can purchase themselves, or we can get into a contract with a laundry machine provider, or we can buy the machines outright. There's a lot of different ways in which you can execute to increase the laundry income. There are other ways you can collect other income too, through pet fees. I mentioned before, talking about A-class product, about trash valet service, meaning that you put your trash outside your door as opposed to taking it down to the dumpster and people come around and collect it. This property too, interestingly enough, I mean, I would just want to live on this property for this alone. They have a free maid service right now. So they have a maid service that comes in now. Obviously with COVID, it's been put on hold, but they have a maid service that comes in and cleans your apartment for free. So obviously people are already, very well versed in having someone come in and clean their property. And this is something that they're, very committed to. And that's something that there's no way we could keep that for free. So that's something that is a service that we could provide for a fee. So that's an opportunity as well. Of course, there are, all different types of fee structures you can get into with vending machines. That's another opportunity as well. So we do have a few options on the miscellaneous income.
I think I've probably looked at all the questions and I missed something. I absolutely apologize, and I would urge you to get back to me if I missed something. I know there were some overlaps, so I might have missed your question, which I thought was an overlap and was not. But I think we are, in the essence of time and respecting everybody's, it's late in the night here in the East Coast. Ashley, what is, I know you've been doing this road show and been asked a bunch of questions. Is there a question that we missed here, our audience missed here, that you would like to bring up from your side?
Just trying to think. You've covered a lot. I mean, everyone has asked really excellent questions here. I'm just trying to think if there's any additional question that we didn't cover, but no, I think we've covered a lot of it.
A wide variety of questions. And well, I really, really appreciate you coming on, Ashley. Thank you so much for providing our audience here very deep insight into the deal. I think not too many sponsors do that take a live deal and go through the details and numbers and everything that you've done tonight. And I appreciate the audience that stayed with 90 minutes almost gone by, and most of the audience stayed along. So thank you once again, and thank you, Ashley. And like I said, I'm here anytime you want to reach out to me. If you want to participate, just send me a note. You'll get a presentation from me, the copy of this recording. So hope you had as much fun as we did. Thank you for joining, and good night.